All right, why you shouldn't have bonds in your retirement portfolio, and frankly, even your pre-retirement portfolio. We're going to talk about that here today at the Heritage Wealth Planning YouTube channel. This will go against all everyone talks about retirement planning. A 60-40 stock to bond mix, or a 40-60 stock to bond mix, or anything. It doesn't matter. Or you should say minus your age by 100, that's how much bonds you should have, or whatever. I mean, there's so many different rules and regulations on this, and I'm going to debunk all that right now. It's so simple to understand, and once you understand the concept, you'll say to yourself, yeah, I don't think I want bonds. Remember, Social Security, pensions, and income annuities should be looked at as your bond portfolio because they pay a guaranteed income that you cannot outlive. You can't. Because there's a guaranteed income you can't outlive, that should be what you look at as your bond side of your portfolio. Now, is there residual value at the end of the day? No. Will there be a residual value at the end of the day of your bond? Yeah, I'm going to show you why not so much. Not as much as you think, for sure. All right, so let's dive right into this. Oh, if you like what you see here, subscribe down below. And, of course, always do the bell. I think the bell's up there to be notified for future content. Because we do about 3 hours of content a day here at Heritage Wealth Planning YouTube channel, my friends. This is my full-time gig, and I love it. And as long as I got money in the bank where I can pay the roof over my head, I'm going to keep doing it. All right, so let's go right into it. It's literally the simplest equation you've ever seen. We have $100,000 in a bond, and we're going to say it's a 10-year treasury. 10-year treasury. All right, so $100,000 in a 10-year treasury. If you look at your trusty old phone, which is recording me now, you'll see that $100,000 10-year treasury pays me 3%. That means I give I loan the federal government $100,000. And in return, they're going to give me 3% a year, which I have to pay tax on, okay? And then after 10 years, I come back and I collect that $100,000. So it sounds good in theory, except watch this. Let's just say I'm in a 15% state and local tax bracket, or state and feds tax, all right? So I'm losing 15 cents on the dollar to the state, and I'm losing it's the state and federal government. So we take our trusty calculator here, we say 3% is our gross interest minus 15%, and so we're going to net after taxes 2.55. That'll be our after-tax return. What happens on top of that? Well, we have a 3% inflation. That's what I use in my financial planning software. You could say this 2.6, which it looks like the cost of living adjustments typical for Social Security, but if you do that, you're wrong, because we know for a fact the Social Security COLAs are based on a CPI urban worker, CPI UW, which includes a lot of stuff that retirees aren't part of. And when you look at retirees in particularly, the urban worker, which is a clerical worker, is not reflective of what a retiree's inflation is, because a clerical worker has less when it comes to medical costs, which is at a higher inflation rate than the clerical worker's CPI UW. That's just urban and clerical. UW, urban, I think CPI UW is CPI urban worker, a clerical worker is what they call it. So if you're retired and you're looking at 2.6 for the CPIW, which is what inflation is based on for Social Security, you should think again. And I use 3% here. All right. So let's do this again. We're going to subtract. We're going to wipe off all this. And I think you can see where I'm going here, though. We're saying we have 3% interest minus 15% to tax, which gives us 2.55 minus 3% inflation, which means we're losing 0.45% a year. That's what we're losing in terms of purchasing power. All right, so that means when you come back 10 years from now and you're losing 0.55% a year to taxes and inflation, you're going to have less in there than what you put in. So you put $100,000 in, and we're losing 0.45, $100,000 future present value. We're losing 0.45. I got to do negative interest for 10 years. We're going to have $95,590. That is what we have after taxes and inflation right there. And that's only at a 15% tax bracket. That's it. And that, again, remember, if it's in an IRA that comes out, it's all coming out as ordinary income. It could affect other taxes as well. So $100,000, what we started with, it leaves us that right there. That's why bonds are bad. It should not be used as part of your retirement portfolio, because you're losing money. You're absolutely losing money. And then we can even make it worse if we say, okay, instead of a 10-year bond, we're going to buy let's say a 30-year bond. All right, so a 30-year bond, we'll just say it pays 4% a year. So a 30-year T bond, 4% a year. All right, so now we're locking in 4% a year for 30 years. So we're in the 15% tax bracket minus 15%, which will give us an effective, we take our trusty calculator, we say 4 minus 15%, that's 3.4%. Minus 3% inflation, and that's probably low over the next 30 years, but I don't know. So we're netting 0.4%. So in real numbers, if we net 4.4%, $100,000 is our present value. Our interest is 0.4%. For 30 years, we'll have $112,000 after inflation and taxes. $100,000 on this side equals $112,000 on that side after 30 years. Neither of those are good. 10-year scenario, you lose a little bit of money, you're not making money. I mean, you are keeping up with inflation, but you're not making anything. 30-year scenario, you made $12,000 after 30 years. My friends, it's just not worth it. Now, I get all the time, but bonds in the 80s, I get it. Those days are not here, though. That's all there is to it. Those days are gone. In fact, even the same scenario, if you would have ran these same scenarios of bonds in the 80s, the reason why I could get a 30-year bond in 1982 paying 15.25%, because everyone thought inflation was going to eat it alive. Because back then, you get shorter term money. In fact, it had an inverted yield curve. The yields on the long bonds were lower than the yields on the high bonds, the short bonds. The only reason that happens is because we think inflation is going to rear its ugly head each and every year, and it's going to just decimate short-term cash. I mean, we've seen this throughout history, my friends. And so yes, someone made out like a bandit who bought a 30-year bond in 1982. That's a fact. I guarantee at the end of the day that someone did it and he got lucky. No other way around it. He didn't do it and say, I think inflation is going down because the Volcker and Reagan know what they're doing. Maybe Arthur Laffer did, and he's the guy who came up with the Laffer curve, if you're familiar with the tax revenue. I bet he did it, frankly. But at the end of the day, let's just say he did. Let's say he was that guy who knew that the inflation was going to get knocked down and a long bond was going to be worth a lot of money. Okay, well, it doesn't matter. You fast forward till today, you're still only getting 4% on that 30-year bond. And now inflation is down here, all right? So you get 4% on the 30-year bond with 3% inflation, factor in tax rates, you're not making any money. $12,000 over 30 years, whoop-de-doo. There's no money to be made in that regard. And so people who are relying on bonds as part of their 4% rule, and it's a money-losing operation, I'm just telling you right now, you can't afford money-losing operations in a long-term strategic retirement plan. You can't. The only way you can afford money-losing operations is by getting income out there that you can't outlive. Now, in this case, you could take the 4% a year, $4,000 a year, but that's fine. $4,000 a year, you're going to come back and collect 30 years from now, you'll be 95 years old if you're 65 today. And so let's just say you take the $4,000 a year to spend on, and you got $100,000 in there now, and we're saying 3% inflation, and we got 30 years, you're going to have $40,000. That account's going to be worth $40,000 if you don't, because inflation is eroding the purchasing power each and every year. That's just at a 3% inflation, my friends, and it's not growing. There is no growth in bonds. Sing it with me. There is no growth in bonds. There is no growth in bonds. Everybody now, there is no growth in bonds. There's not. It's impossible for a bond to grow. Let me show you again why that's the case. It's so simple. And I'm telling you, I did not know this myself for a long time until I read some research by a guy. It was a Dave Blanchett or Wade Fowle. I can't remember. Maybe it was Blanchett. But a bond issues at $100,000. It matures at $100,000. It's literally that simple. There's no growth. The bonds do not have any growth. There is no growth in bonds. You get 3%, you get 4%, it doesn't matter. You're getting that. It does not grow. It actually declines when you factor inflation. There is no growth in bonds. I cannot stress this enough. And you need growth to keep up with inflation. There's just no getting around that. Now, a bond that doesn't grow will give you a 4% a year interest. Well, that's fine. I mean, if you want to use that 4% a year to spend on it, well, I got no problem with that. But in terms of a 4% rule that is taking inflation into consideration before taxes and before fees, those 4% rule doesn't count taxes and doesn't account fees. Now the caveat here, which is what I talk about all the time, is you might spend $100,000 a year from 62 to 72. All right, so let's say your consumption is $100,000 a year from 62 to 72. Once you hit 72, your consumption actually drops to, we'll say, 85 a year. And then when you hit 82, it drops again to another 76 or something like that. That is the caveat. That's the golden ticket, that your consumption will reduce, most likely, for most people, does significantly each decade that you progress in your retirement. And that is the one caveat, and this isn't for bonds, but why you don't have to freak out so much about your retirement plan. That's the one caveat, is that you will not inflate your consumption. You will actually deflate it, because you're going to consume less and less and less as you age. So when it comes to bond, that's not part of the equation for the bonds. When it comes to people who say, I got to focus on this 4% rule, and they're putting 40% of the year of their portfolio in bonds, I say that, I'm telling you right now, that's kiss of death, because you're losing money. There's no other way around that. You don't grow bonds. Now, some people say a bond will be issued at 100 at 3%. All right, so that's the issue price. At 100, we'll just say that's the par value of the bond. Par value simply means the maturity amount too, but also that's the issue price, so the issue amount that they're loaning it to the general public. So okay, at $100,000, sometimes that bond will drop to $90,000. So people say, well, or sometimes they'll go up to 110. Because people say, well, Josh, the reason I made $10,000, a 10,000 capital gain in that bond. Well, the only reason that you did that is because this right here, you can no longer get 3%, you get 2.5%. Everything's equilibrium. And what that means is the only reason a bond that has been issued will go up in value, because we already proved there is no growth in bonds, will go up in value is because the comparative interest rates of the day have gone down in value. Hope that makes sense. So basically, what happens is I'm getting $3,000 a year on this bond. All right, no matter what, I'm getting $3,000 a year on a bond. So I'm buying a bond, I'm getting $3,000 a year, which means $100,000 equals 3%. Now, if I got a bond I can go buy at 110, I will not get 3% a year. I still am only getting 3% a year. So I say, how much will that yield be? It's simple. 3 divided by 110. That yield will be 2.72. What would I do my... Hold on a second. Oh, there it is. 3 equals 2.72. Because I'm getting $3,000 a year on that, but I'm also getting $3,000 a year on this. And that's how it works with bonds. No matter what happens, for the same risk, same maturity, a bond that is at 100 is paying me 3%. A bond that's 110 is paying me 2.72. On the other hand, a bond that's at 90, so I'm getting 3, it's paying 3.33. So you got that's the par value, equals 3,000 a year. 110 equals 3,000 a year in cash. 90 equals 3K a year in cash. This is 2.72 yield, 3.0 yield, 3.3 yield. Do you notice the same thing? They're all paying the same amount of cash. That's all that matters. When people buying similar maturity bonds and similar credit quality, the only thing they're looking at is the coupon, not the coupon rate, the yield that they're going to get, the cash flow. So if I'm going to buy a bond that's issued at 100 and I'm getting 3%, now a couple years later I can go to the same market and I still want to get that $3,000 a year, but the bond has gone up in price. I'm only getting 2.7 because I'm going to pay 110 for a 2.7% bond. That's going to give me $3,000 a year, which simply means the bond's gone up in price because the interest rates accordingly with similar to bonds has gone down. On the other hand, I can pay $90 for a bond and get $3,000 a year. That means it's paying me 3.3%. I hope that makes sense, because that's the critical thing when it comes to bonds. Sometimes you will see a quote-unquote gain in there. It's not growth. That's just a temporary gain. Temporary. Because at the end of the day, that sucker is going to come back to maturity at 100. It doesn't matter. You are not going to be able to sell that bond at maturity for 100. At maturity, you're going to issue that bond back to the issuer, and they're going to give you $100 back. So essentially, you could have a small capital loss there. It all works out in a wash. But you buy 110 bond, you're getting a 2.7% yield. It's literally mathematical certainty right there for sure. If you want $3,000 a year in interest, you're going to buy a bond. You're going to pay 110 for a bond, and it's going to give you 2.7% yield, and that will give you 3%. No other way around that. But that's the way it works. Now, if you want to pay a discount bond, you'll pay 90, which will give you the equivalent of 3.3% yield. It'll still pay you $3,000 a year. That's how it works with the bonds. At the end of the day, though, they're both going back to the $100 maturity. There will not be any growth there. Now, theoretically, people say this all the time. I hear this all the time, and I want to nip this in the bud right now. What if I sell that 110 bond? So I bought a bond for 100 at 3% equals 3K. That 100 went to 110 because I'm still getting 3K. I'm still getting 3K, but everybody else, for them, they're going to get if they want 3K, they're only going to get 2.7% yield to get that 3K. So I'm going to say I'm going to sell that bond for 110 and get a $10 gain. $10 gain, all right? So I got 100 bond that I bought at 100. It's paying me $3,000 a year or 3%. Now the price has gone up because people still want $3,000 a year in income. So now the price in that bond has gone up to 110, which means their effective yield, their what's called the current yield, is 2.7. So they're getting more. They're paying more for a lower amount of money of yield in order to get that $3,000 interest. So theoretically, I could sell that for $10,000 and pocket that gain. All right, so now I have $10,000. What do I do with it? Can I still get a 3% bond at par value? No. It's just like if you sell a house. It's no different than selling and buying a house. My neighborhood, all the houses are 50%, so I'm going to sell it and lock in 50% gain. But you still got to go buy something. You still got to go buy another house. What other house are you going to buy? You can't buy a house at yesterday's prices if you sell yours today. It doesn't work like that. So if you're going to sell yours at a premium, you're going to still have to go buy another house at a premium. The exact same thing happens with bonds. People say, well, I'm going to sell my bond for a gain. Okay, that's a premium. That means you have a premium bond. It trades as a premium over the issued amount. You're going to take that $10 gain that you have. Well, you're still going to go buy something for a premium. No one's going to say, hey, Josh, you sold your bond for a premium, but we're going to sell you ours for a discount. It doesn't work like that. I still got to reinvest that money in something at a premium price, just like real estate. And that's why bonds are dangerous, because no one gets this. They think if I got a gain, I can sell that bond for a profit and turn around and buy the same bond that I initially bought at 3% yield. And you can't do that. It doesn't work like that. So at the end of the day, bonds could not be any more mathematical certainty. You know for a fact what you're going to get, and you know for a fact what is going to mature at. There's just no getting around that. We know you put $100,000 in there, you will get $100,000 at maturity. We know if the issued value of a bond is $100,000 and you pay it for $110,000, we know for a fact you're going to get $100,000 at maturity. You're going to put in $110, you will get $100 back. We know that. There's just no two ways around that. You buy that bond for $90, we know you're going to get $100 back. There's just no two ways around it. That's how it works. Bonds have no growth. You start with $100, it ends with $100. If you get in there at a $100 bond and you pay $110 for it, that means you're buying it because the interest rates have gone down. You're still going to get $100 back at maturity. You buy a bond at $90,000 on a $100 initial issue bond, that means you bought it at a discount and you're going to get $100 back at maturity. That's how bonds work, and a lot of people don't get this. If you have that premium bond and you think you can turn around and sell that and pocket that $10,000 and go buy a similar bond that you initially bought, it doesn't work like that, my friends. It doesn't. So what does that mean to you? We talked about how inflation and taxes erode purchasing power of a bond. A 10-year bond, you'll break even basically. A 30-year bond, you'll lose money. No other way around that. Could you, on the other hand, buy a 30-year bond like you could do in 1982 and make out like a bandit? Sure. Is that going to happen today with interest rates so low? No, just not. Because inflation, the Federal Reserve Board wants inflation between 2 and 3%. So if you think you're going to buy a 30-year bond at 4% and you can turn around and sell that guy later on down the road, knowing full well that the Federal Reserve Board is tasked to keep inflation between 2 and basically 4%. That is what they're trying to do. We know for a fact, that is a fact, there's charter is to inflate the currency by 2 to 3% each year. So we know inflation will never be on any significant amount of long-term time less than 3%. It just won't, because that's the charter of the Federal Reserve Board. On any given year, it could be. That's called a recession. That's called a depression. But the Federal Reserve Board is enforced to make sure the monetary system inflates by 2 to 3%, and that's what they want to do. They don't want a whole lot higher. They certainly don't want it lower. They don't want deflation. They want a small level of inflation each and every year that people can bank their money on. So if you go out and buy a 30-year bond at 4%, you know for a fact you're going to put $100,000 in, and at the end of the day, you'll have $112,000 after 30 years. That's exactly what will happen. And I'm sorry, my friends, that is not enough when it comes to the real inflation that retirees have to contend with health care. It's just not. And it's only going to get worse, too. We have more and more old people getting into the system, less and less young people able to work for them, for sure, less and less young people willing to work for $8 an hour. It doesn't take a rocket science here to realize inflation for retirees is only going to get worse. So if you're buying bonds as a way to save yourself with a 4% rule and all this, I'm telling you, man, think again. Either convert your bonds to an income stream that you can't outlive, recognizing there will be no residual value upon your death. That's the issue. There's no residual value on your death. Well, I just showed you the residual value on a 30-year bond is, what did I say, $40,000? Okay, good luck with that. The residual value on a $100,000 bond is, I think it was $99,000 or something like that. Good luck with that. That's not going to get the job done. An annuity, or I guess an income annuity, if it pays, what I say, like 5.5%, so that will have no residual value. I know that for a fact. But you know you're getting more upfront today in order to deal with impending inflation that's going to come eat you alive for sure. That's why I'm a fan of the second bucket being looked at as annuities, Social Security, and pension. And these are income annuities. These are not variable annuities, not fixed annuities. They're income annuities, turning bond-like investments into income streams that, A, you can't outlive, and that you get more bang for your buck on the front end when you really need the money the most. On the back end, when your consumption starts going down, the annuity is probably not going to pay you enough. We know that because most of them don't have a good cost of living adjustment for inflation, and there's no residual value. All right, but that's fine. But then because you have the third bucket, in this actually case, the second bucket, which is your stocks, and hopefully the stocks cooperated, you can start pulling money off the table of the stocks to put it back in the cash bucket or annuitize it, do whatever you want. At the end of the day, bonds are not your friend. Watch out for bonds. Watch out. And I hope this helps. So if you have any questions, thoughts, comments, put them down below. I know there's a lot to consider here, but man, I'm telling you, this is one thing that just drives me crazy. People think I can sell my bond for a premium and turn around to buy the same bond I bought before. No, you can't. I can sell my bond. My bonds in 1982 paid 15%. I should be able to get that. No, it's not going to happen. Or I say, well, the bond since 1974, it's averaged 8% a year. It's not going to happen. There's no growth in bonds. You know for a fact what you're getting. I debate that. I'll debate that to anybody. We know a 10-year bond pays 3%. That's what I'm getting. That's no other way around that. 30-year bond pays 4%. That's what I'm getting. 4%. There's no other way around that. Unless it goes bankrupt, and then I'm not getting anything. So, all right, I'll let you go here because that's I'm getting fired up on that. Subscribe, comments, questions, concerns. Don't forget to go to the blog at heritagewealthplanning.com, and we'll see you next time. Thanks, guys.